Welcome to our taking stock video for the week ending the 13th of September 2024. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to discuss all things share markets. Matt, I know you're an avid Carlton supporter. How are you feeling now that Carlton's out of the finals?
Well, we're not talking about football anymore, Ken. So, very familiar feeling in September having holidays.
I know, but just before we get started, though, just a quick yet important reminder: the information we provide today is of a generic nature and therefore shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Also just a reminder, our virtual masterclass session, that's going to be on the 10th of October. It's fast approaching. It's designed to help you master all elements of Stock Doctor so you can maximize the return on your membership. So remember to sign up if you haven't done so. Let's talk about markets, Matt, both here in the US, and we're seeing the market's trending higher over the week, and that's been supported by the US tech sector. You know, we saw chipmaker Nvidia. They rallied quite strongly after their CEO said the business was struggling to meet demand expectations. But this comes despite underlying inflation in the US rising by about 0.3% for August, and suggesting that inflation remains quite sticky. In fact, the annual core inflation rate, that's currently at about 3.2% and well above the Fed's target of 2%. And although futures markets now are anticipating a 25 basis points interest rate cut by the Fed next week, there is now debate on whether that pace of rate reductions will continue.
Yeah, there is plenty of debate out there, Ken, and it was yet another week of US traders just buying the dip after last week's sell-off. And it was particularly of note, I think, was the actual day of the inflation print. I thought trading intraday was truly remarkable. Initially, the market was fiercely sold off, and at one point, I think the market was down about 1.6%, only to stage one of the most incredible reversals into the close, where the market closed up 1%. So it was about a 3% swing intraday. And this level of intraday volatility is a pretty good illustration of the level of speculation going on in the market at the moment, whilst what we think is fundamentals are largely being ignored. And this is why we continue to remain of the view that markets are pricing in a perfect economic landing, despite significant risks on the horizon, which are suggesting a less than perfect landing. On top of the sticky inflation data released in the US this week, the US economy is slowing, as indicated by cooling jobs reports and weaker manufacturing data. And here in Australia, GDP data has revealed a paltry 1% rise in economic activity over the year to June. That's the weakest growth rate since the mid-1980s outside of recession. But unlike in previous years, consumers have run out of savings accumulated during that pandemic period. And in addition to that, the Chinese economy is stalling, with both services and manufacturing activity in decline over the last few months. And this has been reflected in weak commodity prices, especially across copper and iron ore, which tends to be barometers for global growth rates. And with the upcoming US presidential election, the debate was this week: ETF inflows, the artificial intelligence boom, speculative activity, especially among social media participants in that meme stock arena. We expect to see further downside volatility across equity markets, hence why we continue to neutralise the risks within our managed funds.
Yeah, certainly risk management is so important now, given the volatility in the markets, Matt. But speaking about volatility, commodity prices, especially over the week, there was a strong rally across the lithium market, which has sparked a short covering on many lithium stocks, especially among our borderline star growth stocks, Pilbara Minerals and Mineral Resources. Remember, both these stocks have very high short interest, meaning hedge funds were betting on further price declines, and now they have had to cover their short positions.
Yeah, if you thought it was a wild week in US equities on that inflation print, then step into the arena of lithium investing. Prices have been down 85% since its highs in 2022, and most lithium mines at the moment are unprofitable. And over the week, there were reports that a major Chinese electric vehicle battery maker, CATL, has suspended its mines and closed its lithium carbonate production line, leading a few investment bankers to tell clients that lithium prices have entered what they believe to be a bottoming range and could potentially rise up to 25% in the near term. Further illustration of this supply response last week, closer to home, is ex-Star stock Acadium, and they did tell investors that it would need to put its Mount Cattlin mine in Western Australia into care and maintenance by mid-2025.
Yeah, the supply of lithium is certainly been affected here, but both Pilbara Minerals and Mineral Resources, they remain our key picks in the sector. However, investors will need to manage their resources exposure diligently, holding a portfolio of at least 15 stocks and ensuring you are not over concentrated to any one particular stock or segment, especially given that lithium prices can be unpredictable in the short to medium term. But turning our attention now to some of the other Star Stock highlights for the week, let's move from resources, Matt, to the retail sector, where we initiated coverage of a few Star Stocks during that reporting season. So one of them is footwear retailer Accent Group. Long-time Stock Doctor members should know this name pretty well, despite concerns about lower consumer spending. Accent's share price has held up pretty well, and the company is expecting its return on equity to rise to around 19% on the back of a 7% rise in their earnings for financial year 25.
Yes, very familiar name there, Kien. And the business is managed by a man, Daniel Agnostinelli, who is very active in steering the direction of the business towards more profitable brands and trends. And he's also been able to close these unprofitable stores, move away from brands that are unprofitable, and has secured some exclusive distribution deals with active footwear business Hoka, and continues to expand into more profitable newer brands such as Nude Lucy and Style Runner.
Yeah, targeting that younger audience base, Matt. But in addition, you've got the business is expected to generate an improvement also in their free cash flow, which is well above forecast dividend payments and should support that gross dividend yield of about 8.5%. So it's quite an attractive yield. Now, let's talk about another retailer, fast fashion jewelry retailer, Lovisa Holdings. Matt, can you walk us through that?
Yeah, it's an interesting story, Lovisa, isn't it? And again, a very familiar name within that Star Stock universe. And over the course of the last 12 months, it has defied the negative earnings trend that we've experienced across the industry, with many retailers not being able to expand their network. That's very different for a company like Lovisa that has that global footprint and is able to expand that store rollout. And the company has also benefited from solid cost control and flexibility in product pricing, thanks to its vertically integrated supply chain. And this has translated to a market-leading ROE of over 100%.
Yeah, that's an incredible figure. The company's ability to generate such abnormal return on equity and profit margins. And that's due to the combination of the Lovisa store being very low footprint, meaning they allow for cheaper leases and lower costs. And also you mentioned that vertically supply chain, which allows Lovisa to control their costs as well. And of course, they've also got very minimal marketing expenses and relying mostly on social media to appeal to that younger audience.
And it is a founder-led business with billionaire investor Brett Blundy on the board. He still holds a ginormous stake of 40% in the business. And with regards to management, investors need to be mindful that Lovisa's incoming CEO, John Cheston, has been removed by his previous employer, Premier Investments, Solomon Lew's company, for anyone out there that's not familiar, for serious misconduct. So while we remain wary of the situation, we do note that Mr. Cheston isn't expected to join Lovisa until the financial year 2026.
Yeah, so for full details on these stocks, please refer to our commentary. This week, we're taking a closer look at new entrant into our Star Stock universe, Redox, and the code is RDX. The business is a global distributor of chemicals, ingredients, and raw materials, and they handle over 1,000 products. And they were only listed in July 2023, but has been profitable since listing, Matt. So first of all, can you explain what a distributor does?
Sure can. A distributor acts as effectively the middleman between manufacturers and customers, typically retailers or wholesalers. And in the case of Redox, they source products from manufacturers around the world and act like a sales representative for the producer, dealing with negotiations, marketing, and payments.
Yeah, thanks for that clarification, Matt. And I noticed that this is also a founder and family-driven business. It was formed by Roland Corneliano and now is run by the Corneliano family, who has significant skin in the game. So, Matt, what is Redox's competitive advantage here?
Well, firstly, they source commodity products from dairy to fertilizers to around 940 manufacturers. And there are many distributors out there, but in the case of Redox, its competitive advantage lies in the product experience that it has, its regulatory expertise, quality assurance, and its logistics network technology. This has allowed it to generate an ROE of 19% and net profit margins of over 8%.
Yeah, very attractive metrics there, Matt. And it looks like the outlook appears promising as well, with return on equity expected to expand to over 35%, driven by synergies of the acquisitions that they've made. Although investors will need to be mindful of the low analyst coverage here. In these cases, our analyst, Dan Ortiza here, he usually does deep dives into the company, speaking to the management and assessing their future opportunities.
But the great thing about a lack of analyst coverage is that it allows investors to jump into these opportunities early before they become mainstream. It's also encouraging to see Redox recognised as a star income stock with its attractive dividend yield of 6.4%. Now, although the track record of dividend payments is quite limited, our research team do believe that the gross dividend yield of over 6% is sustainable on the back of low capital expenditure and unstretched payout ratios and very strong net cash position.
Yeah, speaking about dividends, Matt, and with the founding family still involved, they are highly motivated to keep dividends flowing, given that they are the largest shareholders. But as always, investors need to understand the risks. And given that the majority of their products are imported, the business is subject to supply chain risks, which include higher freight costs, currency risks, for instance, and also the potential for delayed transits. In this week's Question of the Week segment, we explore the concept of the founder effect and whether investors should care about whether a company's founder is still involved. So, Matt, what is the founder effect and why is this so important?
Well, the founder effect does refer to the influence a founder can have on the company's performance, and founders oftentimes bring long-term vision and a strong personal investment in the business's success.
Yeah, exactly. If the founder is still part of that executive team or board or holds a large stake in the business, it shows that they have skin in the game. That can be a big plus for investors looking for stability and leadership continuity and also alignment of interests here. So how can investors find out if the founder is still involved?
Well, you can start off with a simple Google search to find the founder's name, then use Stock Doctor's Corporate Details tab to check if they're still on the management team or board. You can also check for large shareholders to see if the founder has significant holding in the business.
Yeah, and a large shareholding means an entity or person might have that influence. For example, let's take a look at Redox again. They were founded by Roland Corneliano. While Roland is no longer with the company, we can see that the number of his sons and grandkids are still prominent members of the executive team and also substantial shareholders of Redox. As such, we can conclude that the Corneliano family still have influence on this company.
Exactly. And Stock Doctor makes it very easy to see both management roles and shareholder stakes, helping investors assess the founder's ongoing impact to the business.
And of course, for Star Stocks, our analysts will let you know whether the founder is involved in our commentary as well. But that's all we have time for today, Matt. Appreciate your insights as always.
My pleasure, Kien. And if you have any questions, please feel free to tune in to our Lincoln Live webinar on Monday morning.
Also, just a reminder, we are rolling out a few services which may be quite interesting to a few members. We've got the Platinum Stock Doctor service, that's exclusive communities where you'll have direct access to Tim and the senior investment team, attend premium events, and also gain insights into your portfolio there. We're also conducting that virtual masterclass event later in October. So feel free to sign up. And also, last but not least, we are running a refer a friend or family promotion, with the grand prize being that luxury winery experience at Penfolds McGill's Estate in South Australia, with 5-star accommodation and also a bottle of Grange for you to take home there as well. Our business grows because of you, our members, and we appreciate your ongoing support and loyalty. For the time being, take care and have a happy, healthy, and prosperous week ahead.